In the previous video, which you can find here, we established that the current valuations imply extraordinary expectations. The question now is simple. How can these extreme valuations resolve? History suggests that there are three different possibilities: a crash, stagnation, or eventually the earnings catching up. My name is Michael Frömmel. I'm a professor of finance. After 30 years of research at universities, central banks, and in the financial sector, I want to share my knowledge and provide you with the evidence-based insights to make better financial decisions. Most investors immediately focus on the first possibility, a crash. That's understandable. A crash is dramatic. It dominates the headlines and the news, and investors immediately lose a lot of money. But crashes are not the only way how we can resolve a high valuation. Consider some famous examples. 1929 markets crashed. 2000 markets crashed. 2008 markets crashed. Yet in each case, prices found a bottom and valuations returned to a level where future returns became attractive again. The bottom itself became an investment opportunity. The second possibility is stagnation. This is a scenario that most investors underestimate, but that scares me as an investor most. For example, the valuation peaks of 1901 and 1966 were not followed by a market collapse like 1929 or 2000. They were followed by years of disappointing returns until valuations and earnings had caught up. Not necessarily because prices crashed, but because valuations gradually adjusted over time. That brings us to a distinction I find particularly useful. In a crash, the market does the adjustment. In stagnation, the calendar does. Valuations will still return toward normal levels, but time does most of that work. So which of the two possibilities is more painful for us as investors? Sure, a crash is painful, but it is fast and ends quickly. History suggests that most crashes complete the bulk of their adjustment within a few years. The Dotcom crash, 2000, ended after around 2.5 years. The global financial crisis in 2008 reached the bottom after less than 2 years. Most smaller crashes reach the bottom within a few weeks or months. And there is one important advantage. Eventually, valuations become attractive at the bottom and investment opportunities appear. The next bull market can begin. Stagnation is different. Returns disappoint, year after year. This is psychologically much harder. One of the most famous examples is the period after the valuation peak of 1966. By the late 1970s, Businessweek published a famous cover story titled "The Death of Equities." The article argued that after a lost decade, the equity investment culture had effectively died. A few years later, one of the biggest and greatest bull markets in financial history started. The third possibility is that earnings catch up. This is the optimistic scenario. Valuations start at an elevated level. But instead of collapsing, the earnings start growing, and gradually it becomes easier for the valuations to get justified. In other words, fundamentals do the work. A good example is a period between the early 1980s and late 1990s, when the United States experienced one of the longest and strongest periods of economic expansion in modern history. Inflation declined, productivity increased, technology adoption accelerated, and earnings grew steadily. Valuations were initially supported by improving fundamentals rather than by pure speculation, before expectations began to outrun reality in the second half of the 1990s, the dot-com bubble. The key question, therefore, is not whether AI works. The key question is whether the earnings can grow fast enough to catch up with the high expectations already reflected in prices. Don't fall for the trap. Subscribe and stay ahead. Thank you. At this point, most people compare the AI bubble with the dot-com bubble. I would like to discuss another historical example, high-frequency trading, because I believe high-frequency trading teaches us an important lesson about competition, technology, and profitability. High-frequency trading came up in the early years of the new millennium with the digitalization of financial markets. It is not about applying sophisticated models. It's just about trading faster than your competitors. Tiny latency advantages generated enormous profits, and often a few milliseconds mattered. Early winners earned extraordinary returns, and the share of high-frequency trading rose to an estimated 60 to 70% in some markets. But competition followed, and the firms spent more and more money for faster hardware, networks, microwave links, and co-location. Every millisecond became more expensive than the previous one. A real race of arms. Initially, profits were extraordinary. Some traders never experienced a single day ending with a loss for years. But then, between 2009 and 2013, profits dropped by estimated 80%. 80% in 4 years. Why? Because competitors copied the advantage. What began as a technological edge gradually became the technological standard. Economists have long understood this phenomenon. Schumpeter called that the erosion of innovation returns. What was once extraordinary eventually becomes the new normal. The obvious question is whether AI will follow a similar pattern. Several firms that aggressively integrated AI into their customer service and back office functions, including firms such as Walmart and Uber, already scale back their deployments, according to reporting by the Financial Times. Furthermore, several AI providers are moving from flat rate subscriptions to token-based pricing models. As Costi Pericos, head of generative AI at Deloitte, recently observed, the cost of computing resources is starting to worry both CFOs and boards. Consumers and businesses have been taught that AI is cheap or even free, but that's definitely not the case. Others have even started bringing back employees to roles that were actually expected to be taken over by AI. So the most important question is not whether AI will change the world. It will. It will create value, but we don't know how much and for whom. The question is, how will the high valuations be resolved? By a crash, by stagnation, or by earnings catching up? No model can tell us with confidence which of these paths is the most likely one. Each of them has its supporters. What do you think? Which scenario is the most likely one? Leave your opinion in the poll and in the comments. Thank you.